What's up, everybody? It is November, so it is once again time for me to share two deep value stocks for this month. Now, with the market very close to all-time highs, it is getting harder to find deep value options, especially ones that I haven't talked about on the channel before. I've talked about pretty much all of my major holdings on this channel, some of them multiple times in many videos. And in this series, I do try to share some fresh ideas, some stocks that you're probably not hearing about from other channels on YouTube. I think I have a couple interesting companies for you today. The first one is a solid business that has grown earnings per share double digits for decades that is currently trading for a single-digit multiple. I've only mentioned it briefly in one previous video, and the second stock I've never talked about before. It is a consistently profitable company that is trading for less than their cash on hand. They have no debt, over $400 million in cash, and they're trading for a market cap of $400 million. So I hope it's interesting. As always, if you get value out of the video, subscribe to the channel. I'm doing a live stream tomorrow, November 2nd at 2 p.m. Eastern Time, 11 a.m. Pacific. So come on by if you want to look at some stocks. And finally, last bit of promo here. If you want to make spreadsheets like this, or if you want access to my website that I am building out, then consider supporting me on Patreon. Link to that will be down in the description below. And now let's get into the first company, and it is Euronet, ticker symbol EEFT. I do not currently own this stock. However, I've been looking more and more at this business over the past month, and the more I look at it, the more I like it. This company has been around a very long time, more than 3 decades. They went public in '97, and they started as just a network of ATMs. They made money from the fees on their ATM network, and this is actually still a hugely profitable segment for them. It's what I would call the core business of this company. It is the most profitable part of Euronet, and this isn't just ATMs that they have in, Europe and Asia. This is also card issuing and processing for banks, and also their merchant solutions division. In this quarter, they signed up 7,000 new merchants. For these clients, Euronet is processing those payment transactions. The other two segments of this company, ePay, this is a lot of, digital gift cards. Their clients include a lot of brands that you would recognize: Amazon, Epic Games, Riot Games, Apple. This is a low margin segment of the company, but you want to buy a prepaid card or gift card for one of these brands. That's what Euronet's doing here. And finally, the last segment is money transfer. Here, they're facilitating mostly cross-border payments. Ria, Dandelion, these are their big brands here. The people who are using their business here might be tourists, might be workers who are remitting money back home to their families. Margins for this segment, not very high, but that's typical for the business. Now, revenue growth has slowed in this quarter, and I think that's something that investors are a little cautious about. In the past, this is a company that has grown at a very nice clip. If we just search for Euronet here on my site, I'm going to very quickly pull up their financials, and we see revenue has basically gone up and to the right. We had this blip during COVID. Obviously, during COVID, not as many people traveling, not as many people using ATMs, sending money across borders, but this is a company that has been consistently profitable, steadily growing for decades. They use some of that cash that they generate to acquire other businesses, which they've done very successfully, but a lot of that cash is coming back to shareholders in the form of buybacks. My metric owner's yield here represents what percent of market cap is actually getting paid back to shareholders. Incredibly high at 13%. That's probably not sustainable. They put a lot of money into buybacks. Clearly, management thinks the stock is weak, and when you look at the numbers, they're trading at 10 times trailing earnings, about 8 times forward earnings, a little less than 8 times free cash flow. This is a growing, profitable, well-run business that is trading for an 8 times multiple. It has gotten very cheap. And if we look at the stock, the stock is right at a 52-week low here. In fact, just a few months ago, the stock was roughly 50% higher than its current level. Even over the past 5 years, the stock is down. The company has more than bounced back from the hit it took in COVID. However, if you look at the stock really hasn't. It's never gotten back to these pre-COVID peaks, and I think the market is really sleeping on this one. Another thing I like about the company, it is founder-led. The CEO, Michael Brown, he has a ton of skin in the game. He's been running this business for over 3 decades, almost 2 million shares. He's heavily aligned with shareholders. It's something I like to see. And in case you're wondering, by looking at these metrics here, how is institutional ownership over 100%? Well, it's because some of the shares are sold short. 12% of shares sold short, so a little high there. And going back to the quarter, it wasn't a great quarter. Revenue was up 4% for the business, but I tend to look at constant currency, what was changing, and revenue constant currency basis only up 1%. That's because they're reporting in dollars here, but they make their money in a bunch of currencies from all over the world, especially in Europe. The euro has been strong against the dollar recently, so that makes the dollar numbers look a little better, but constant currency, 1% growth, not great. Now, they're about a month into quarter four, and they say that they're seeing improvements. However, they do highlight on this call that they feel like the consumer is a little bit weak. This is something that Deckers also talked about when we looked at their earnings. They're pointing out discretionary spending of consumers, a little bit soft. For Euronet, a company that is, dependent on travel, when people go places, they're spending money. Well, if you're spending a little less, or if you're not taking that trip in the first place, then that's going to be a hit to Euronet. And maybe this is a broader trend to look out for and a little bit of dark clouds on the horizon because you have a bit of a bifurcation in the economy here. You have some large businesses that are putting up great numbers, and the companies that are selling to those businesses, like most notably, just to give an obvious example, Nvidia, whose clients are Amazon and Google and Meta, they're doing very well. But the companies that rely a bit more on consumption, just a bit more on selling to the everyday consumer, there's a number of them now that are reporting a bit of pressure. Now, even with all that, the CEO said on the call, they're still on track to deliver double-digit earnings growth this year. They use a ton of that money to buy back shares. They repurchased over $100 million in shares in the quarter. As far as the future, an analyst asked on the call, historically, Euronet has been a double-digit EPS grower throughout its history. If this, meaning the challenges the company's facing right now, persist, can Euronet still generate double-digit EPS growth in 2026? And the CEO said, absolutely. We've been doing this for 20 years. We see a lot of opportunities. We got CoreCard, hopefully. CoreCard is an acquisition that they are making. It hasn't closed yet. We'll likely get more information on that next quarter, but this would be accretive to earnings per share, and this is in the card issuing and processing segment. So coming back to our sheet and thinking about what we can expect for the future of this company, I have my assumptions that I put in down here. My base case, I think I'm being fairly conservative here. I'm assuming 4% revenue growth for the next 5 years. Yes, this is higher than where they were this quarter, but it's significantly lower than where they've been historically. I don't think the company deserves to be punished this much for just one bad quarter. Management has been excellent for decades. They're saying they're seeing improvement in quarter four. Now, operating margin, 12%. I am pulling it a little bit back from where they have been recently. Free cash flow margin, this is what I think can come back to us shareholders in the form of buybacks, and I'm giving them just an 11 times multiple. I don't think these are crazy assumptions, and in this scenario, you're looking at an 18% annualized return on this stock, 130% return over 5 years. That's great. Now, as far as my bear and bull case, bear case, I'm assuming no revenue growth for 5 years. This company just stagnates. A decent amount of their business still relies on cash. If you think that that is in terminal decline and, maybe the rest of the company grows with inflation, but nothing crazy, then you get no revenue growth and margins compressing. I'm bringing back their free cash flow, and I'm only giving them an 8 times multiple. And in this scenario, you're actually still up money on 5 years. Yes, it's not much, 2%, basically a 10% return over 5 years. Nothing anyone is going to write home about. But still, this is a pretty ugly scenario I put in here, and you're not down money. Now, as far as what the upside is, if the business continues to grow at mid-single digits and operating margins basically just stay exactly where they are now, if the company just re-rates to a 15 times multiple, which isn't anything insane and certainly something the company has traded for many, many times in the past, then you are looking at an over 30% annualized return on this stock over 5 years. That's close to a quadruple on your money. So honestly, when I look at the risk reward for Euronet, I like it. I like that it's founder-led. I like that management has skin in the game. I like that they've shown consistency over a very long period of time. And yes, I like that the stock is very cheap. So as far as what I'm doing here, as I said, I don't currently own a position in Euronet. I think a lot of that is because I'm relatively new to the company. I've only been looking into this business for about a month, and I like what I see. I may buy a position here in the future, but as of today, I'm not a shareholder. Now, let's talk about the second company. And the next stock is Gravity, ticker symbol GRVY. Now, this is a company that, once again, I don't own, but I've actually been following for a very long time. In fact, in this sheet, I even have a write-up of a bull case and a bear case that I wrote almost a year ago here. Now, just to pique your interest here, Gravity is trading for a market cap of about $400 million US dollars. The company itself has over $400 million on the books. If we just take a look at their balance sheet here, cash plus short-term investments, that's about $430 million. And this is a company with essentially no debt. It is not common to see a company trading for less than its cash position, but typically when you do find a company like that, there's an obvious red flag, like you know they're not profitable. Essentially, they're burning through the cash, and the market is saying, yeah, we think that they should trade for less in cash because over time we actually believe that the cash will go down. However, for Gravity, this is a consistently profitable business. They simply make more money every single year, and that money just gets piled up on the balance sheet. The cash position just keeps going up and up. So what is going on with this business? What even is this company? Well, Gravity is a gaming company and they own the IP to Ragnarok. Ragnarok Online was one of the first of these, MMORPG games. It reminds me a little bit of World of Warcraft, although I have to say I've never played Ragnarok. But you have a character and you level up. And if we look at the business, we see that they just exploded in 2017. And this is when they took this IP, which Ragnarok, it's been around for decades, but they brought it into mobile gaming. They've now made a ton of games based on this Ragnarok IP. And, they're not the developer of all these games. Sometimes they license the IP out to another studio and they're just taking a cut of the game. But we see here Ragnarok Origin, Ragnarok X, Ragnarok Zero. It's still incredibly popular, by the way. Ragnarok has a very dedicated following. And yes, revenue spikes higher when they have a very successful game launch, but regardless, this is an extremely profitable business. They're basically just printing money. They continue to release more games. I mean, they are just milking the Ragnarok IP for all it is worth. Profit by quarter goes up and down depending on, how much they're spending on marketing that quarter. So, quarter two, they had a strong release, Ragnarok M Classic, but they also had high marketing, so profit was actually down. Regardless, they keep on making money. The vast majority of that is coming from mobile. We see here the player base predominantly in Southeast Asia. And looking at the numbers, really everything looks good. Their numbers, by the way, are in Korean won. This is a Korean company. So the question is, the stock looks like a complete no-brainer. Should we be buying Gravity here? I don't currently own the stock, and there is one red flag, but it's a pretty big red flag for me. Yes, they're sitting on a ton of cash, but why? Why are they sitting on a ton of cash? Why is this not coming back to shareholders? Why aren't they buying back stock or paying this money out in the form of a dividend? Well, this is actually pretty typical for a Korean company, especially one with essentially no corporate governance. Gravity is owned primarily by another business, Gung Ho Entertainment. You see, they own roughly 60% of the shares, so they have complete control here. You have no say as a shareholder, and if they just want to sit on the cash, there's nothing you can do about it. I've emailed investor relations for Gravity multiple times over the past year. My question is always the same. Do you plan on returning capital to shareholders? What are your plans for the money that is sitting on the balance sheet? And the answer I get is pretty much always the same, which is we have no plans to return capital to shareholders. We're just holding the cash, and we might use it for an acquisition. We don't know. You might look at a company like this and say, what is the risk? They are trading for less than the cash on their books while being consistently profitable, making more and more money every single year. Well, the risk is that they never give this money back to shareholders. They have no plan to do so. And someday they're going to use this money to make a bad acquisition. They're going to buy up some other asset, some other IP, and you will never see money coming back to your pocket as a shareholder. It's very hard for me to value a business like this and decide, what do I think would be a good price for a company where they can essentially do anything and they have no accountability. I don't know if a company like this is suitable for the traditional model I use to look at businesses, but I will say that as the cash continues to pile up and as the price continues to come down, it does get attractive. If this company came out tomorrow and said we are starting a dividend, even if it's quite a small one, I would almost certainly be a buyer. But today, as it stands, I'm still not sure. I think for certain that Gravity is a deep value company. It just has the wrong management mindset. And with that, I think I will leave this video here. I hope you got value. If you did, subscribe to the channel. If you want to join a live stream, come on in tomorrow. I've never done one before, so I don't know what it will be like, but I imagine we're going to talk about a bunch of stocks. If you want access to the initial version of this website that I'm building, or if you want to make Google Sheets like the ones I have here, consider following me on Patreon. And as always, if you agree or disagree with anything I said in this video, leave that down in a comment below, and I hope to see you all in another one.